In the 14th and last lecture of this course, European integration, we'll talk about some of the challenges that the EU faces and the integration process faces in many, many different dimensions. Most of them have to do with macroeconomics and finance, but also, of course, the pandemic, the immigration surge that has occurred since the onset of the Russian invasion of Ukraine, but also the constant surfeit of people coming from Africa who would like to come to Europe and work, or coming to escape political or other sorts of persecution at home. So this is going to be the subject of my last lecture, and in doing so we'll use a lot of the principles and ideas that we've just explored throughout the course, and I think you'll see for yourself this is great food for thought. So to summarize, we'll look at last week's lecture briefly. We'll talk about the sovereign debt crisis as the first real challenge to the EU. First a real challenge, because it went at the heart of the most important European project, which is the common currency. Since the introduction of free trade between countries, the common currency has really been the most interesting and dominant grand project of Europe. Okay, and of course, it went wrong in the sense that a series of developments required a concerted effort on the part of Europe's institutions to save the euro and save the common currency, but also to save the banking system, to prevent a backlash of bad political and public opinion reactions to the European Union. We'll talk about the role of the central bank. The ECB played a central role in saving itself, but also saving the European project and saving important institutions that garner a lot of trust in the economic system, like banks. Okay, and we'll talk about some of the open, unfinished projects that are related to that project of the introduction of a common currency, which has to continue in terms of a common banking system, a common capital market. And in doing so, we'll see that eventually we reach a limit of people's willingness to accept this integration. So think of integration as a spectrum, and in some sense, the European project has a location on the spectrum, and the complete integration of Europe might be associated with things that we don't want to have, like getting rid of our own national language and national history and national culture. Nobody wants that, but that's an inherent part of the 500 million people that constitute Europe, depending on how you look at it. And that means that at some point one has to slow things down a little bit. So we'll talk about the path of further integration, which at some point will run into political union, and the associated difficulties, commensurate issues, problems that arise when political decisions have to be made across national boundaries between countries of people with different tribal instincts, different languages, or different histories. And of course, this has to do with governance, trust in the governance. As I said already, the European Central Bank is probably one of the few institutions that after the 20 years of its existence, plus it's actually established itself as the most serious European institution that can do things that are quite powerful and in a way that's recognized as being legitimate, even though it may not be democratic enough for most people. Central banks are inherently undemocratic in the way they behave, because they have to take decisions very quickly and take decisions that may hurt people's economic well-being or help it, and sometimes in ways that seem unfair. And yet the European Central Bank is populated by a governance system, run by a governance system that is democratically legitimated, because elected governments have appointed these officials, and the European Parliament approves of them. So in some sense, there is a certain amount of sustainability and governance there. But other further issues of European integration, such as a tax and spending authority at the European level, really have not reached maturity as of now. We'll review the course, and I'll finish up with that. Last week we talked about fiscal policy and the way it is inherently related to monetary policy and a monetary union, even more so because the monetary union has the authority to create money and liquidity, the means of payment, and in some sense should be insulated from the fiscal authorities. And that's the theory, and that's why the Maastricht Treaty was implemented in such a strict way to prevent current and future manipulation of monetary policy through the fiscal behavior of a single region getting too big to fail or borrowing too much, in a sense violating the idea of a monetary union at the heart. So we talked about sustainability, what that means in terms of the dynamics of the debt stock, absolutely, but most importantly relative to GDP. And the absolute stock of debt is accreted by net deficits of the consolidated fiscal sector, of the consolidated governments, and as a result, understanding the dynamics of debt require understanding the dynamics of the primary surplus and the interest payments that a country has committed to pay already by virtue of the stock of its debt at any particular point in time. So stabilizing debt requires a relationship between the primary current account surplus, i.e. the net tax revenues minus expenditures on goods and services by the governments consolidated in relation to the debt service that has to be paid. Okay, and that equation will govern our thinking and your answers on the final exam, trying to understand what it takes for a country that's highly indebted to balance its to stop the debt stock from rising too fast relative to GDP, and that means that you have to bring in the growth rate of the real economy into the equation. We talked about the Stability and Growth Pact as a successor to the Maastricht criteria, which were just an entry condition, and then how the club has to be maintained. People have to behave when they're, upon entering the club, people should not be allowed to misbehave. Okay? And then we talked about supply side policy as an unexplored part, but very important part of raising the tax capacity, the tax revenue capacity of the member states of a monetary union and helping them obey their intertemporal budget constraints. So let's try to apply this to the first real crisis faced by Europe. I'll show you exactly what I mean in a second, but the idea is simply we faced a situation in 2009 when, at the end of 2009, the Greek government basically conceded that its current deficit, headline deficit as a fraction of GDP, was twice as large as they had reported in the official statistics. This was associated with a change of government, but also associated with a change in credibility for the Greek statistical agency, because this was just off the map in terms of mistakes. And it led to a series of increases in the interest rate for Greek debt, which eventually priced the government out of the market, in the sense of not being able to borrow at normal terms. And under these conditions, not just Greece, but Southern Europe in general, were under attack by the financial markets, in the sense that their bonds were sold en masse and the interest rates were rising, raising their refinancing costs, and given that they were all indebted anyway, meant that they were facing literally bankruptcy. And because governments were not allowed, or it was not foreseen for governments to be bankrupt in the European Monetary Union, this was a real crisis. This was a blind side, a real blind spot for the European Monetary Union and for the European Union as well, since all these countries interact with each other. Any country having serious payments problems will certainly have effects on non-Euro member countries. It turns out that Southern European countries in Southern Europe, Southern European countries, upon entry, actually did quite well. They were growing fast. They met their Maastricht targets with the exception of Italy. They had lower inflation, so we understand why that might have been justified from an internal political and in terms of preferences, why they would think that's a good thing. Italy was able to get its inflation rate down considerably, Greece even more so. Interest rates fell upon entry because they were paying and borrowing in euros, and the nominal euro rate was significantly lower than the nominal drachma rate or the nominal Italian lira or peseta rate or escudo rate, which meant that people suddenly had access to a borrowing potential that they could reach that they had never tapped into before. And this drop in interest rates was associated with the drop of inflation, which at the time seemed quite rational because inflation was on a lower trajectory. So people took advantage of this. Aggregate demand rose. We could call this a consumption boom. It was also an investment boom. A lot of apartments were built. A lot of people bought real estate and speculated, or even bought new houses or new apartments. And just by the standard ASAD analysis, this consumption boom could be thought of as a rise in, as a shift outward of the AD curve, leading to higher output levels relative to the trend, so an increase in the output gap, but also an increase in inflation. Okay, this led to an internal appreciation because you have the common exchange rate. That means that the local price is rising faster than the price in Germany or France. So that means German goods and French goods became more and more attractive. So the southern countries began to buy lots of stuff given this price development. So for two reasons, the initial surge in demand, but also the fact that their purchasing power in euros was increasing in terms of the foreign non-local goods. We call this an internal appreciation, and the usual concomitant loss of competitiveness is the consequence, and you can see it in the data, that if you look very, very carefully at the colored lines, you see that most of the southern states were persistently above the level of Germany, and did so even throughout the 2000 decade. So even though inflation was coming down and was low, it was persistently higher than it was in, for example, Germany or France. And as a result, we have exactly what the ASAD predicts, an increasing level of GDP relative to trend, but also an increase in the price level and a deterioration of competitiveness. This is a fantastic figure I took from the Frankfurter Allgemeine Zeitung back in 2007. This is just a few months before the American financial crisis hit, but also more importantly, just a couple of years before the Greek proverbial hitting of the fan. You can see this on the left-hand side. We have a measure of price competitiveness in terms of the change, and you see that Germany, over the whole period, 1999 to 2006, since the introduction of the euro, was becoming more and more price competitive relative to the other countries, the ones that are showing up in red. Most importantly, Ireland, Spain, Luxembourg, Portugal, also Italy and Greece. And if you look at this on the basis of the price level, which is kind of a competitiveness is incorporating unit labor costs. In addition, the inflation rate accumulating over time meant that countries like Ireland, Greece, Spain, and Portugal, those are all the countries that had the massive financial sovereign debt crisis that I'm going to talk about, and also Italy, are all on the red side, meaning that their prices were increasingly higher relative to the average in the euro in the euro area. So we call this a chronic overvaluation inside a currency area, which cannot be a good thing, because if you have that, as we know from our previous classes, the way to get back is to have a competitive internal devaluation, meaning your inflation rate has to be lower than the other guys for some period of time, or for some reason Germany and France And Finland and Austria have to have a persistently higher rate of inflation for several years to undo this imbalance that you see here, because this price imbalance led to current account imbalances. Okay? It was also associated, as I said already, with real growth differentials that were quite significant, and they led to a really lopsided external position for most of these countries, meaning they were running a very large trade and current account deficits with, of all countries, Germany, but also with France and other Northern European trading partners. Okay, so the standard narrative, and there are two narratives for this financial crisis that I think you should be aware of, but the most standard narrative that I particularly like, because it makes sense in terms of macroeconomics, is that there was a rightward shift of the ASD curve, real exchange rate appreciation, and maybe they could have done something about it. The Southern European countries could have acted. They could have actually tightened fiscal policy in this wonderful period when interest rates were wonderfully low, and I'm talking about between 2000 and 2007, they could have put the brake on, and that would have helped pay off reduce their debt liability, their debt to GDP ratio. They don't have to reduce the indebtedness, they just have to slow down their accumulation, but the boom, the fiscal boom meant tax revenues were rising, and there was just very little incentive to put a foot on the brake when things are going so well. Very difficult to do this politically. And we see this looking at the data, but let's just remind ourselves what I'm talking about. I'm talking about this convergence of interest rates followed the convergence of inflation rates, and they may have overcompensated a little because the real interest rate in a country like Greece or Spain was actually significantly lower than it was in Germany. So this common currency with a common perceived capital market, because if you look carefully what this implies between 2001 and 2008, there was literally no spread between Greek 10-year government bonds and German 10-year government bonds, or for that matter, Irish, Italian, or Portuguese debt. So under those conditions, with different inflation rates that are expected to persist in the future, it was really a bargain for a Greek construction firm to build another office building, or for a Spanish hotel developer to build another hotel in the Costa Brava, because in terms of the real interest rate they were facing was much lower than building the same type of resort auf Rügen. However, this convergence stopped. Obviously, it stopped with the financial crisis, and if you look carefully, you see it coincides with the end of 2008. This is when it was discovered that Greece was misreporting its deficit. Remember, the deficit is one of the core indicators of whether a country is supposed to be in the Union. Greece was already in the Union. They entered in 2001. And all of a sudden, we realized that, hey, the Greek numbers are kind of cooked. This means that international investors that hold Greek bonds are starting to doubt whether these bonds will continue to pay on time, as bonds are supposed to do, into the future. So any doubt about that would cause a rational investor to start unloading these bonds. And the history, of course, as I've told you in Macro II, is that an American investor by the name of Gross from the largest pension investor, PIMCO, in the United States and the world, with I think on the order of $3 trillion US dollars at the time under management, decided to find out about this and tried to call the Greek finance minister and talk to him or her about that. Unfortunately, this minister was unavailable for a conversation, and Mr. Gross got very upset and decided to sell the entire, not just the entire Greek portfolio, but to sell his holdings in all Southern European countries. I think he kind of smelled something coming, and that's the first little blip you see in the late fall of 2008. Okay, and that little blip led to a cumulative sell-off of Greek debt, which again sparked people's interest in the possibility that a lot of other countries would be in a similar situation. And as you can see, the Greek government debt, the yield on the existing debt, which you have to understand means the price of purchasing an expected stream of payments into the future, dropped like a stone, meaning that the effective yield for those people willing to buy was on the order of 25 to 30%. So it's a great deal if you're willing to accept the risk and unease of having a very uncertain stream of future payments, because maybe the Greek government will become bankrupt, may leave the euro, adopt a new currency. A lot of investors shared that sentiment, and they also shared the sentiment with respect to Italy, Portugal, Spain, and Ireland, because Ireland was also over indebted and obviously overbuilt, and the price of Irish houses, just like in the United States, was starting to fall. So what happens as a result? Well, obviously, the Greek government cannot maintain its borrowing at 30% at a 30% refinancing rate for 30 years, and for short-term debt, it was probably much higher. So in some sense, it was impossible for them to operate. It was just either they're going to hang it up, default, which would be a minor disaster, because banks hold Greek debt, not just Greek banks, but French banks and German banks. And the Commerzbank in Germany was one of the big holders of Greek debt in 2008. So it became clear that the governments would have to step in and save the system, okay? And the Greek government doesn't have the ability to print its own money, so what does the Greek government do? It has to go knock on the door of the European Union, in particular the European Monetary Union, in particular the European Central Bank, and ultimately the IMF became involved as well. So under these conditions, rising interest rates cause output to fall, as we know, and that means the tax revenue base starts to fall. So just measuring numerically debt to GDP, that thing has to go up. Okay, it goes up for two reasons. One is the deficits are increasingly large relative to the past. So the increments to the numerator, we called it BY, BP in nominal terms, will start rising faster, but also PY, especially Y, real terms, starts to fall. Okay, and that's exactly what happened after 2008. Okay, especially with respect to Greece. Greece's indebtedness rose to 180% quite rapidly. Portugal around 150%. All these countries went into a program of austerity because, as we learned last week, you have to reduce G or you have to raise T relative to Y, i.e. raise the primary surplus, which can be quite difficult in the short run because that leads to decline in aggregate demand, which causes more unemployment, more misery, and more political blowback. That's the standard interpretation of what happened. Excessive deficits in the early and middle 2000 decade led to an overvaluation, loss of competitiveness, and the lack of policing of banks led to a moral hazard problem. The people who bought those bonds in the middle of the first decade of the century decided that this is a no-brainer because the government will bail out Greece if it gets into trouble. We call that the moral hazard problem, and that seems to have also governed people's behavior. I think if the Deutsche Bank had been operating in Greece in a big way, lending to Greek people and lending and borrowing from Greek households in Greece, that would have changed their attitude towards holding Greek debt because they'd be on the hook as well. And this overconfidence led to excesses that in turn led to a sudden stop, and a sudden stop is when you pull the plug quickly, and that's exactly what we saw in the chart before. Now, one of the biggest problems was indeed the fact that there was not a banking union at the same time there was a monetary union. Monetary union means we're all using the same money, but most of what we call money is not banknotes, it's basically bank accounts, credits at a bank. So you have an account with a positive balance. You can use that to buy yourself your groceries or pay your rent. When banks are in trouble, the banking system has the government and the economy on the hook because the payment system is hostage to the health and behavior of the banking system. So the banking system supplies the money, and therefore it, takes a given supply of high-powered money and sort of multiplies it up. As we know, in the end, this is what banks do, and they do a good job, otherwise they wouldn't exist. They'd be bailed out all the time. They actually lend to people who are credibly able to repay over time. Sometimes they underestimate the the fragility of the structure of payments, and they also may overdo it when it comes to lending. When it comes to lending to certain borrowers, and especially the government. Most importantly, the banks supply trust. They supply our confidence that we can use these bank accounts as if they were cash, because cash is inconvenient when it comes to transferring it, when it comes to just bringing it. It's always dangerous. You worry about getting mugged or losing the banknotes. That's why we have banks. So it's all about deposits at banks, and we know that indeed in most of the European countries, banks are creating up to 95% of the means of payment. So a monetary union has to address the solvency of banks and their ability to engender trust going forward. These are just some illustrative numbers. You can see that it's not uniform. The most confident banking systems around seem to be in Scandinavia, because the Scandinavians use very little cash. They're happy to use credit cards and debit cards that access bank accounts, liabilities of banks that we own. Less so in Poland. This is data from 2015, but things haven't changed that much. Germany is also a country that likes to touch the cash, but it's becoming less and less the case, especially since the pandemic. So, basically the unintended consequences of financial integration that I talked about at the very beginning of this course, real capital mobility and the attendant financial capital mobility that helps lubricate the real capital mobility, has an unintended feature, which is that there can be sudden stops. Okay? And this is driven by banks, which are, if they get too large, they can be a source of systemic risk across the European borders, because banks do lend to each other, and sometimes they're still in a national mode, and therefore they're susceptible to national crises and can't insure themselves across borders. So this financial integration actually became the Achilles heel of the Eurozone, not the mortgage lending that we saw in the United States. That was kind of a problem in Ireland, maybe because the Irish copied the American model to some extent, but ultimately Ireland's a very small country. Some banks in Germany were exposed to Irish mortgage lending, and one in particular was very exposed, but the financial integration became the Achilles heel, because some banks were exposed to government debt, and when governments were faced with a bailout decision, then the banks associated with that, with those governments, tend to suffer the loss of the value of their bonds, and that affected the balance sheet of those banks, and then affected the confidence of people to hold deposits at those banks. This is a picture I showed to high school students. It's kind of interesting to think about. Think about the financial crisis in the United States as looking like this. Households that are saving are brought together with firms or governments who are borrowing. Ultimately, intermediaries do this job, and there are many types of intermediaries. This is a very hard chore. So financial institutions like banks or insurance companies or other types of funds can literally bring these two parties together. Sometimes they don't even have to be simultaneous. I can be a banker, I have a great potential project that I'd like to finance, and I know how to raise the money in the capital markets and access the savers, which may also be firms, in the aftermath. But in some sense, the intermediaries act between the firms and and government borrowers and the households. And some households are borrowing as well. So it's maybe also be the case that some firms and governments have excess that they're interested in saving for the short term. So think of this complex system of bilateral intermediation between banks and similar types of institutions. Talk about insurance companies or hedge funds. They may be doing intermediation or direct dealings with households on both sides of the borrowing nexus, and then they also may be lending to each other. Okay, so the complexity of the system is not a two-way street; it's actually a multiple-way street, and meaning that some hedge funds may have extra liquidity that they lend to a bank, and that lends to another bank, and the idea is pursuing the greatest return. This is often seen as an efficient system when interest rates are high, when interest rates are low, maybe less the case, but in any case, it's a way for financial institutions to make money. And that's just the way they work in an integrated system like this. But of course, a loss of confidence in the system will lead to any one of those little institutions, those could be quite large institutions, but any of those intermediating institutions to get sick because a counterparty can't repay or is short on liquidity and can't access liquidity elsewhere. And that would mean that some of these red connections dry up, and then as a result, some of these institutions may get sick. Okay, they may in the case of the U.S. financial crisis, many of the lenders to the mortgage companies that were, or to the construction companies that were building houses, the mortgage companies that were organizing mortgages to allow households to finance their construction projects, had a drying up of their funding, and when that happens, then they can't do any lending, but that means the business dries up as well, and any counterparty to this financial institution is also in trouble. And it's very difficult to know the exposure in the first instance. So overall, we have this ailment of the financial system started in 2007 in the United States and proceeded like a slow-moving train wreck. And eventually some banks, as you know, became insolvent, and then the Fed has to make a decision, or the banking system, the FDIC, has to make a decision whether a bank is to be closed or not. Some of these banks were quite large, and some of these mortgage lenders were very large and had to be taken over by the government. And the government, to keep things running, would have to borrow money in the end on capital markets or get financing through the Federal Reserve, the Central Bank of the United States, to fix the situation. And of course, at the same time, the price of the assets of these banks are falling, and these falling prices worsen the balance sheets of these institutions. We have what's called a fire sale situation. It can only go bad. In Europe, the situation looked a bit different. The global capital market was tapped into by select Northern European banks, and they were lending to Northern European borrowers, but also to core banks in the south at the periphery, and these banks would lend in turn to households and firms in the southern and periphery countries. I say periphery, I'm talking about Ireland, of course. And what happens is when the global capital markets get skeptical about the situation in the south, they restrict lending, and this means that the northern banks are in trouble because they can't refund their lending. And you can see how this led to a contraction of lending bank to bank within the European monetary union. We talk about it. We speak of a compartmentalized situation where it's like baffles in a milk truck to prevent it from collapsing, but it also means that the milk doesn't flow very quickly, and that means that a financial crisis can be aggravated. Now, in the case of Greece, it's a small country, right? Greece is a small country. It's about, at the time, it was 4% of European GDP, Eurozone GDP. It's probably 2% of EU, depends depending on how you measure the EU, maybe 3% of EU GDP. The problem was that Greece had a large stock of debt and it was held by foreigners, okay? And when that's the case, it's a source of risk. And a small country with a very large debt stock, which is nonetheless small in the big scheme of things, can be sold very quickly. As we talked about, Bill Gross's pulling the plug. When PIMCO pulled the plug in December of 2008, 2009, it led to a severe crisis in Greek public finances, and that led again to furthermore to a problem with Greek banks. And when Greek banks are involved, that means that other creditors to those banks are also threatened. So you have this sort of domino effect. So by 2010, 50 billion euros had been purchased already by the European Central Bank. And that was kind of a violation of the usual principle that central banks, or the European Central Bank is supposed to obey. They're not supposed to buy debt of a particular country. This was done under the guise of stabilizing the markets in this very turbulent time. And if Greece had defaulted, this would have been a complete mess. So I think the agreement that was the case led to this implicit bailout of Greece in 2010, which was just the beginning because other countries were under attack. So many countries, 4 countries in particular, Greece, Portugal, Spain, and Italy, were under considerable pressure, Ireland as well. And this is just an example of why, because foreign debt was important. And it wasn't just Greece, as I said already, Portugal, Spain, Ireland also had large holdings outside. You can see that Germany was less exposed to Greece, but more exposed to Ireland at the time. And of course, Spain being a large country as well. And Britain, the United Kingdom not being in the euro, was also exposed. So again, they weren't free from the worries that we had. But in Germany, it was important because Germany, being a central country in the European Monetary Union, was faced with a real crisis in terms of what happens when people start to dump their Greek debt en masse. It's going to have a fire sale effect. And there's some particular firms, particular banks, financial institutions that were particularly exposed. I already mentioned Commerzbank, but the Hypo Real Estate was doing all the lending to Ireland, and the Deutsche Bank had some exposure through its own main activities, but also the Postbank, and of course the insurance companies, Allianz, Münchner Rückversicherung, and then DZ Bank, and the famous HSH Nordbank in Hamburg. So these are basically banks that were exposed to Greece. Now Greece, as I said, it started in December of 2009 when they doubled their reported deficits, which has led to this drastic action by a single player, which obviously had some knock-on effect because people know if PIMCO is selling, then they must know something that we don't know because we didn't know it before. We believe the finance minister of Greece in 2009 in the summer, and that's why the interest rates just continued to rise because people just were participating in this discovery that things in Greece were not looking so great. And then when interest rates are high, refinancing the deficit that was already underreported would cost a fortune. It would just be impossible. Greece would be in default. The consequence of this attack was that government debt in all the countries, given the exposure of their own banks to their own government's debt, meant that they needed to be bailed out. So the government was on the hook twice, and therefore the yields on government bonds to these exposed countries rose very, very fast compared to the benchmark German Bund. In fact, if anything, the Bund yield after 2010 fell, so people had a flight to safety while they were fleeing the Greek and Portuguese and Spanish debt. Okay, so if you take this all very seriously, Greece joined under false pretenses. They didn't get their act into gear enough. They should have run primary surpluses. I showed this last week. They had low inflation, but high interest rates meant that there was probably the wrong kind of investment in housing and not enough in developing a competitive industry, because the price of Greek output was just too high relative to the rest of the European Union. So the current account deficits of the Med countries were significant. So we had this picture last week just to remind you. The Greek headline budget surplus never came into balance, and the primary surplus didn't as well. And you can see that inflation at the same time is falling. So the most important collateral damage of this crisis was that falling GDP meant lower tax revenues, increasing spending to help people in need and to stimulate demand meant that budget deficits were even larger. And as a result, this financial crisis became a public debt crisis, which became a banking crisis, which became a further public debt crisis. So by 2011, we see that falling real growth in this table is matched by rising government deficits. Negative sign means deficit. And you can see that the Irish debt deficit to GDP ratio in 2010 was 32%. And this is because in that year, Ireland borrowed a lot of money in the capital market to bail out its banks 100%, to bail out all depositors 100%, in the name of defending their reputation. Germany, less of a crisis because low interest rates and GDP growth was still relatively robust. But in a country like Greece, we had a deficit that even after the error was corrected, was still 10%. And meaning the government has to keep borrowing to bail out these bloated liabilities of failing financial institutions. So you can think of this as kind of a slow motion disaster. Okay, as I said already, the primary surplus of Greece was eventually corrected and moved to the positive direction, as it should be, to stabilize the debt-GDP ratio. We also saw last week that the debt-GDP ratio was stabilized by a concessionary interest rate that was offered by the European lenders, or the European Commission, well, the European Monetary Union participating countries, the European Central Bank, and the IMF basically offered a lower interest rate, effectively a zero interest rate on the deal for the next couple of decades, that Greece would be able to, under the conditions that Greece would run a primary surplus on the government accounts, which they consequently did, even under a socialist government. So this is showing that Greece was pretty serious, and we're able to stabilize the debt-GDP ratio at about 180%. And in the meantime, Greece is growing again, and things are starting to improve. The debt-GDP ratio is falling. Again, this is a picture you saw last week, just to make things very clear. Okay, so we've learned the interdependence of financial stability and fiscal policy is key to understanding what happened. Keeping interest rates in the picture, just to remind ourselves, low interest rates could have been exploited to refinance, invest in infrastructure, maybe even pay off some of the debt. Unfortunately, this was not done. Italy, Portugal, and Spain failed to restructure their economies, and the China shock was hitting at the same time. So we know Italy had some problems already starting in the 1990s. And Ireland and Spain had pretty sound public finances. They had a primary surplus already in the early years, but they didn't watch the banks, and they had a building boom, a construction boom, which led to serious bank difficulties failures and bailouts. Okay, so in general, the countries that were highly indebted ended up having problems with their banks, and that ended up impinging public finances. And that's why the European Central Bank had to do something, which they did in 2012, 2013, making a commitment to do all that it takes to bail out the banks or to save the financial system, which meant the European Central Bank would intervene in open market operations. It would buy government debt explicitly, because by 2012, what was happening was the long-term financing operations that the European Central Bank had offered to banks, sort of long-term lending to allow them to hold on to their assets and refinance their commitments without contracting the balance sheet. These long-term operations started to unravel, and the banks voluntarily started to repay these debts, which meant that the balance sheet of the Euro system, or the consolidated European Monetary Union banking sector, was starting to contract, and this was threatening the stability of the system. So this meant that Mario Draghi committed to all that it takes, meaning that he would increase the balance sheet of the European Central Bank by open market operations. Okay, so the fact that the emperor had no clothes was kind of going to come out at some point. It came out in 2009. It's often claimed that Greece's problems stemmed from the aftermath of the bailout, but that would be unfair and disingenuous, because we know from the data that the Greek fiscal policy path was unsustainable under those conditions, but it was also unsustainable in Portugal, Spain, Italy, and Ireland. This is often called the fundamental interpretation. But there's an alternative narrative that one needs to be aware of, which is that indeed it could also be, the root cause could also be in the financial sector itself. So let's just suppose that it was not the initial narrative I've just been giving you for the past few minutes, that it was actually fundamental, meaning the lack of competitiveness in the light of financial integration and underrelated banking sector led to a banking cum fiscal crisis without fiscal discipline, which led to an overextension of borrowing by the fiscal authorities in these countries, and that led to a crisis. The alternative narrative would be instead that it was a non-fundamental crisis, meaning that the countries could have continued a path on that path that they were, had it not been for this rise in interest rates. So blaming Bill Gross, blaming PIMCO or the financial markets in general, or possibly a hedge fund that decided to attack in advance. This would be called a self-fulfilling prophecy, because we know that the solvency of a government, its ability to obey its budget constraint, depends on the assumed path of interest rates. So if those interest rates are higher, then any given level of income of that government and the path of expenditures will no longer be consistent with financial solvency. So in some sense, an attack in a financial market on a particular government's debt, leading to massive sales of a particular security, a bond, a 10-year bond, say, of Greece or Portugal, would lead to an interest rate increase for new bonds, and that would lead to insolvency in and of itself. It's an important narrative to deal with. This fundamental story is easy to tell, but it is possible that excesses of the financial markets, especially the ease of moving capital around the world, financial capital, selling these financial assets, means that it's very possible that very quickly interest rates might rise, as it did with Greece at the end of 2009. In any case, if there's smoke, there's usually fire. So it's fair to say that a country that has very solid public finances would not have an attack, because a financial attack by a group of hedge funds or big financial players would not go anywhere if the market weren't convinced that there was a story behind it. So we can talk about it. In any case, whether you believe the fundamental story or the non-fundamental narrative, the important thing is to go back to last week and think about this famous formula, which will always loom in the background of your head, because it is basically driving the whole story. This is the story that to stabilize the debt to GDP ratio, if you don't have access to the central bank's seigniorage as a source of revenue, you have to make sure that your primary surplus as a fraction of GDP exceeds this growth-corrected sustainability condition on the right-hand side, which means basically, given your debt to GDP ratio, what is the differential between the real interest rate implied over the next, say, 10 years, minus the expected growth rate over the next 10 years. And this will determine whether people perceive you as being creditworthy and solvent and likely to repay your debt. Therefore, any stabilization package must be aimed at the left-hand side of this equation. How can I increase tax revenues? How can I decrease or moderate spending, all relative to GDP? So if GDP is growing faster in the aftermath or after some measures are taken, then that would make it more likely that the condition is met. Remember, in most cases, R minus G is positive. It's very unlikely that countries are growing faster than the rate of interest for longer periods of time. In the last 10 years, maybe interest rates have been very, very low, and real interest rates have been negative. This is not a sustainable situation as we see in the current setting. So how do we get a stabilization of B over Y? Looking at that equation, it should be obvious that we can first hit the fiscal variables. We can try to raise net taxes. That may also mean raising gross taxes given subsidies, or cutting subsidies given gross taxes. Or you can cut spending on goods and services. And that, of course, can be painful because it may mean you're dealing with people, because you're paying wages, you're building bridges, paying policemen, paying for the army, fixing the highways. You can also reduce B. So I talked about this last week. You can actually sell off some of the family jewels. A lot of these countries in the South have significant government assets. Think of all those Greek islands. You could sell a few of those, or you could sell the state casino, or you could sell the state railway system. Now you have to find a buyer, and you have to find a buyer who's willing to deal with the political blowback of privatization of a key public utility or public transportation. So, or the wharves in Piraeus were sold to the Chinese. I mean, that's another way of raising money. If the price is right, maybe it's worth it, because you can use that to pay down the debt immediately. So you can actually retire some of the debt. You can reduce the debt burden. Of course, this is political dynamite. Many people don't want to have that happen. You can also try, as Greece was successful in doing, to get a concessionary interest rate from the lenders. So instead of because the banks unloaded their Greek debt to the ECB and to the IMF and the other official lenders, basically they're out of the loop. They've washed their hands of this problem. So these government lenders or official lenders can offer lower interest rates because there isn't a market. Okay, it's the taxpayer that's offering the lower interest rate. So this is one way of getting the condition back. If you go back to the condition again and look at it, you can see that lowering R would make this more likely to work. Of course, you can also try to increase output. Now, we know that increasing potential output, Y bar, instead of just Y, requires, think of the solo model, you can have more capital investment for many, many years. Technical progress, which you can't command, it just happens. or you can try to deregulate your economy if you think that's one reason your solo residual is growing less rapidly, or maybe even is stagnating because you've got problems with corruption or you've got problems with overregulation. These are all possible things you can do, but they tend to take time. Okay, it's not something you can turn around in a couple of days. Of course, the final solution would be just to get rid of the debt by defaulting. So Russia in 2017 or Cuba, you can just say, I'm not going to pay anymore. That's it. Okay, but you may have problems borrowing again, and going into autarky mode is not a great thing to have unless you've got some magic potion. So what do we have? We have three policy options of the in the European debt crisis. We basically had an austerity program. So a lot of people associate this with Churchill in the 1920s to get the UK back on the gold standard, or Brüning, the German finance minister in the 1930, 1932 period. Internal devaluation induced by reduced aggregate demand. So think of shifting your AD curve backwards, leftwards, causing the inflation rate at home to be lower, which would eventually increase your competitiveness abroad. And this is a process that takes time. Just ask people in Greece. The bailout, which is the preferred option if you can find someone to do the bailing, or you can default. And sometimes defaults are kind of unspoken, technically a default, but maybe people don't declare it to be a default. You can also exit the currency union. This is something that was discussed seriously by several academics in Germany as a solution to the problems of Southern Europe. But this leads to a lot of dislocation and other problems that maybe aren't very attractive. And again, I've already mentioned the slow versus the slow go supply side reform takes many years. I think looking at Greece today in 2023, the data seems to indicate that after a decade of hard pain and apparent little gain, the price level in Greece is significantly lower relative to the German price level than it was in the year 2009. And this was something that people like Professor Zinn of Munich were actually doubting that would ever happen. But given time and patience, it does happen. And I think given the suffering that Greece went through in the subsequent years to have this happen, would indicate that these painfully acquired gains should be defended by a solid fiscal policy going forward. So it's about long-run sustainability, okay? This may mean taking very seriously policies that make it easier to start companies, easier to keep more of what you have. Sometimes you have to have a progressive tax system, but you can certainly subsidize certain types of entry activity, make it more attractive for people to start enterprises in their European home country rather than emigrating to the United States where everything is easier, allegedly. Okay, so this has been always seen as a trade-off, but it's really only a short-run trade-off. In the end, short-run growth policies can increase output and tax revenues in the short run, but if you can't find a lender, it's not going to work in the long run. Okay, so in the long run, we have to think about the solo model, think about the incentives to work and to save and to invest. Okay. So I think it's unfair to criticize austerity. It's a consequence rather than a cause of the long-run ailments of the European Union. And you can see this really clearly looking at Italy versus Germany. So this is the effect of introducing the euro in two different environments. You can see that actually Italian growth was less associated with the euro. The Italian slowdown in growth really was associated with perhaps the 1990s when China came online. Now, some people look at that figure and say it's actually the it's the financial crisis, obviously. But if you take logarithms of those lines, you see that the slowdown in Italy really started in the 1990s. And this is when key Italian areas of competitive advantage were being lost to foreign competition. And the same, you can see the same in employment. Okay? Okay, so final analysis, no quick fixes. Let me move on to a couple of other challenges for Europe. The other challenge for Europe, I think, is the Target 2 system, which was introduced as a consequence of the euro. Basically, it's a system of intercentral bank liabilities that reflect cumulative current account surpluses and deficits that are not financed by private sector lenders. Remember, the current account is often called net lending by a country. So if Germany has a current account surplus with the rest of the world, it means that Germany is lending on net to the rest of the world. If it has a deficit, that would mean that Germany is borrowing from the rest of the world. And therefore, the current account surplus should be matched by a financial account net lending surplus as well. Within a monetary union, you have the difficulty that is not necessarily the case that international current account imbalances within the European Union are financed necessarily by private sources. So if Italy has a deficit with Germany on the current account and the financial account, it has to be financed on a bookkeeping basis by a change in intra-central bank liabilities. Meaning that if Germany, if Italy has a current account deficit and a financial account deficit with Germany, that means that the Central Bank of Germany has to be doing net lending to the Italian Central Bank in this period. And this is basically a normal aspect of most monetary unions. Okay, it's a closed system, and the same thing occurs in the United States between the Federal Reserve Bank of San Francisco and the Federal Reserve Bank of Dallas in case of a deficit. On the current and capital financial accounts, it would definitely mean that the Reserve Bank District of Dallas would have a loss of a net loss of net liability, or a net increase of liabilities to the San Francisco Federal Reserve Bank. In the old days, this was matched by gold flows. They don't do that anymore. It's just bookkeeping, basically, but it also has some nationalistic flavor to it if the two regions have different names. Like one is France and one is Germany. This is different than the San Francisco Fed and the New York Fed, or the Dallas Fed. You can already see that the Fed districts are associated with cities and not with states. Okay, so that's one of the big weaknesses of the European Central Bank was that it was founded on the basis of the participating countries' national central banks, and these were not abolished. Rather, they were actually preserved. Okay, so again, if you think about this equation, which just says that the current account, whether it's positive or negative, has to be matched by a financial account and an official lending account. And if you have problems thinking about this, think about the gold standard or the Bretton Woods system. And the same thing was true. We had fixed exchange rates. So if the United States had a deficit with Germany on the current account, and it had an insufficient financial account to cover it, it meant that basically the United States Fed, the U.S. Fed, and the Deutsche Bundesbank had to be swapping liabilities to make this balance, because it's a bookkeeping. And under a fixed exchange rate regime, it has to be the case that if the current account and financial account don't exactly match each other, then there has to be an increase or decrease in official liabilities between the two central banks. Okay, so again, this is the old problem. It's kind of reemerged under a new guise, and it's called the Target 2 balance. The Target 2 balances were actually conceived as a way of making payments balances between countries perform more easily, but it's actually just highlighting the fact that these current account imbalances need not be financed by the private sector. And it's not clear that they need to be, but if they're not, they'll be matched by central bank lending and borrowing activity passively to match. And that means that one has to be ready to live with the consequences of very large imbalances. And people like Hans van der Zinn have discussed whether these are debt, because it's not really obvious that the German central bank wants to lend money to the Central Bank of Italy. They're really just balancing items, but they look like debt, and they could be debt if they agreed to put an interest charge or something like that. And I guess ideally you'd want to keep them around zero, but they certainly haven't been zero. Okay, so this is a cumulative look at what's happened between Germany and the rest of the European Monetary Union, Spain and the rest of the Monetary Union. These balances are kind of accumulated deficits or surpluses. Germany has had a surplus a long time with most of the rest of the Monetary Union. You can see that countries like Italy have had a deficit with the rest of the Monetary Union. And most of the small countries have kept close to zero, if not a little bit on the positive side. Now, recently, in the past 3 years, especially since the Russian invasion of Ukraine, the German target balance has dropped by about 10%. So if Germany continues to lose competitiveness vis-a-vis the rest of the European Union, it's very likely that these will get drawn down again. So think of this as like a shock absorber. That's one way of thinking about it. A shock absorber that you don't want to get too much. Put too much air in, at some point it gets to be dangerous, it gets to be political, but things are looking better. Overall on governance, things are looking up. So let me just summarize it is important to get this right. You need to get people to talk to each other beforehand, before the crisis occurs, to talk about what happens. So one thing we should have done, didn't do, could do, is to ask, well, if this happens again, how do we deal with it? If Greece has another attack, if Germany has an attack, suddenly people just start selling the German bond. What would that mean for a country? Can a country go bankrupt? Should we allow that to happen to make investors more careful and more likely to do due diligence on the fiscal policy of countries instead of calling up the finance minister after the fact? This is certainly a problem that the United States faces, and for this reason, all the US states are possibly candidates for bankruptcy. There's nothing to rule out that Louisiana could go bankrupt, and it would mean that in a resolution procedure, the banks that own debt from a particular government would face the possible capital loss of a partial, of a restructuring of that debt, or a partial resolution of that bad debt. Of course, this is unspeakable, but it's part of having a serious monetary union, is a way to deal with this fiscal irresponsibility or fiscal mishaps or fiscal bad luck. So unsustainable fiscal policies need to have consequences that the investors have to deal with, and can't just say, well, it's not my fault, I lent in good faith. Things are getting better in this sense, because over time people are realizing we should have done this. It probably wasn't addressed when the euro was founded because it was politically impossible. It was just politically incorrect to talk about this subject. I think only the Germans wanted to talk about it, but now it's more likely to be an issue. Developing a crisis mechanism with the European Stability Mechanism is probably the first and most important step. Now, improving governance means more risk sharing, means completion of the banking union. So we have this now in the sense that the European Central Bank is supervising systemically relevant financial institutions, but everything beyond that seems to require a treaty change. So we have to actually be able to conceive of a way to make things better and get everyone in the European Monetary Union or in the monetary system, already 19 countries, to get them on board. It ain't easy. It'll be tough. But again, I keep saying it, we have more supervision. These are the reforms of the past 5 to 7 years have required big steps. Macroprudential supervision. We have supervisory authorities now that never existed before. Since the UK left the EU, these have migrated to the continent. I think this is a great thing. We have Basel III, which implies a huge capital enlargement or increase for banks. European banks look much better than they did before, although they've been dragged into the action. And in the case of Commerzbank, involves a government stake. So the government is actually controlling the salary of the CEO of Commerzbank. Maybe that's not such a bad thing. It certainly prevents misbehavior, makes banks pay attention to what they're supposed to be doing and not doing the big deals. This banking union, you could say, started in 2014, but we're still not quite there yet. These are all elements of a program that are still in the making. The single resolution mechanism and the single resolution fund. These are remarks that Klaus Regling made, who was the first head of the ESM and shaped it quite a bit. So monetary policy has changed. I mentioned already two weeks ago that the financial crisis, all that it takes, meant that sovereign bonds were purchased en masse to support the markets, first according to to the capital key. So it didn't look like the European Central Bank was bailing out a particular country, but it did it in a very, very large way. So it made the markets much more active and liquid. At the same time, the market for interbank lending sort of dried up. A large extension of long-term lending operations initially, but were repaid by 2013, and you can see this in the data. The open market program of the what we call quantitative easing that was officially announced in 2015 after Mario Draghi said in 2013 that he would do all that it takes, implied asset purchases that have expanded the size of the balance sheet of the European Central Bank enormously, and we saw those balance sheets a couple of weeks ago. So again, the ESM's idea will be to provide sort of the stability that we have seen in the United States that was induced by the FDIC here, but aimed basically at all banking activity and all banking solvency issues and being able to bail out banks by accessing the credit market. Another European institution that has the ability to raise money in capital markets is very controversial. The European Financial Stability Fund and the ESM afterwards really did quite a bit of action. It dispersed quite a bit of money. In the meantime, even Greece has exited its program. So remember, Italy didn't have a program. Big country, would have been very, very embarrassing. But Ireland, Spain, Portugal, and Greece came under the guise of this EFSF program, and eventually the ESM has the say. And these three countries exited by 2017, and then Greece just exited last year. And this is really great news because it has shown that this long-term perspective does work. The member states are all in the euro, so it was a success. The euro didn't collapse. We have structural reforms. The euro area has basically proven to be has an interest to intervene through the European Central Bank, and the ESM supports debt sustainability. I think going all the way will require even more work, and I think if you read this slide, you see that the single resolution fund is still not quite there yet. I'm not exactly sure what target level, to what extent the target level of 55 some odd billion euros has been reached. I guess you could look it up on the internet to see. It's also important to harmonize national deposit insurance and promote private sector deleveraging, because there's a lot of leveraging that took place. Other challenges. One challenge is really the idea of the four freedoms. So go back and think about the Treaty of Maastricht. I'm not talking about the four freedoms of Roosevelt in World War II. I'm talking about the four freedoms of Maastricht. And they're all things we've talked about in our course: freedom of trade, freedom of moving capital back and forth, freedom of services, freedom of moving people. So these are all economic aspects that we've talked about in our course. Some freedoms were not addressed, like the freedom to start a firm or to run a startup. But these are basically ideas to promote economic freedom as proposed, sort of idealized by Monet and Schuman, and protecting the gains from integration. So you think about it, the first phase of globalization, this is relevant for our course, think about starting with trade, capital mobility, FDI, and then thinking about labor integration, mobility of people in terms of their professions, governing frameworks, rule of law, and then moving on to a common currency, banking union, capital markets. I mean, you could just keep pushing it. You could say, why don't we just have a harmonized taxation system? We already have something like a harmonized VAT. There are bans. We've managed to bludgeon the countries into obeying this. So Luxembourg and Ireland are taxing corporate income. We could even have a national defense system. I mean, we could even have a government. At some point, the European politic resists. So I'm going to finish up my lecture talking about this. This is where the break, the fissure starts to happen, and we start to see some countries just objecting to everything. And this is where we have to sort of say, okay, we've reached the limit of globalization. And again, you think about these different aspects. We think about immigration. That's a part of the European integration project. Equating marginal products of workers across regions seems to be a very sensible thing to do. We know that Europe is running out of people, especially people who are working. Germany and Italy are the primary examples, but other countries have a similar issue. Some form of controlled immigration outside of Europe is going to be important. We need to also figure out, since we already have freedom of movement within Europe effectively, do we need to go all the way and allow people who are coming here for reasons to be protected from persecution abroad or looking for economic advantage here? Do we need to protect them and their rights to move around as well, because they're most likely to do so? There's a lot of political resistance to that. You just have to read the newspapers. You see the rise of populist parties is a direct consequence. So the four freedoms, movement of people is the most problematic. I think the most irritating for the United Kingdom seemed to be the fact that some British towns suddenly became Polish. Okay, the town of Boston in the UK is often cited as one which overnight, over a matter of years, the high street just began to have lots of Polish language signs, and people couldn't deal with that. People began to perceive that they were alienated, that they're losing their neighborhood feeling, and Europe is certainly not the United States. It's not a melting pot. it's really a bunch of tribes. And if you look at the survey conducted by the Bertelsmann Foundation in 2017, people seem to really see globalization as a threat when they consider migration also to be a problem. Okay, so it seems to be, going back to our original public opinion differences that we highlighted, countries where there's a lot of migration and a lot of displacement because of globalization tends to lead to public opinion in the opposite direction. So one way of thinking about the UK is that maybe this is just an outgrowth of this simultaneity of lack of integration, lack of opportunities of their own making, but also feeling threatened economically and sociologically can lead to something like Brexit. So if you look at Brexit, for example, since the announcement of Brexit, the British economy has been transformed incredibly. So a net out-migration of people, especially out of Eastern Europe, so that people really didn't feel welcome, and they weren't welcome, and they've moved back to their countries. I'm talking in particular about immigrants in the UK from Poland, but also from the Baltic states have returned. And this is a real loss of L for the UK economy, a loss of potential employment, potential GDP. So it should be a no-brainer that Brexit, for this reason alone, would be a losing proposition. If you care about GDP, about the mass of purchasing power and economic potential that can be mobilized to redistribute or build your universities, build your highways, pay for national defense, pay for taxation in general. Another challenge that Europe faces is the challenge of another pandemic. Okay, so we know that European countries tended to react on their own, and ultimately there was a pandemic response at the European level. It could have been better. We also saw that this was a threat to international trade. Often the borders would go up between Germany and Poland, or between Germany and the Netherlands, or Germany and Austria as a reaction. This is a threat to openness in trade. So therefore it makes sense for a common way of dealing with the pandemic as a way of promoting European integration and preventing a rollback of the benefits that have been realized over the past 50 years. Brexit is the final challenge I'd like to talk about, in particular, namely the fact that Brexit has been very expensive, not just for the UK, but it's been expensive for the German economy as well. So this is looking just at West Germany to make it comparable with the 1950s and 60s. You can see that Britain joining the EU was a great boon to the German economy, and Brexit has been will be and has been a losing proposition. Okay, so this is basically showing that over time, since the mid-2000 teen decade, UK's share of German exports has declined, and other countries, including China, have moved to replace those lost shares. This is a very interesting study. That's just basically it's called a doppelganger study. So they basically tried to replicate what a British country, a country that is the UK, would look like had it not left Brexit. So the way you do that is you sort of you create sort of a doppelganger, sort of a twin, statistically, from some linear combination of countries that did not leave the EU, and kind of control for things like the business cycle and for other trends in trade or international exposure to big players like the United States and China, and then you extrapolate what would have happened. So that dotted line is basically the fictitious story of a country that did not leave the EU, and you see basically a sustained difference. There are many studies that sort of kind of And here's the study I'm actually talking about, which is the study by Springford, okay? So this is again, the pandemic hit, that was bad, but this blue line is basically a country that did not participate in Brexit, and then the actual GDP is the black line. So overall, even though these methods are very sensitive to the way these data are created, or these estimates are made, the assumptions that are made, it's pretty universally held that British GDP is probably 5% under its trend that it would have had Brexit not occurred. So having this independence of the EU and all the political problems that were perceived to exist may be indeed worth it, but it was a pretty high price to pay. Okay, so let's conclude the course and we'll get out of here. Economic integration is an important and positive force in Europe. We've looked at it from several angles. We've looked at trade, we've looked at factor mobility, institutional adjustment and adaptation. We've talked about a monetary union. We've seen that there are gains from fiscal integration to some extent, to the extent that if you have a common currency, it can buffer shocks, against shocks. And we also saw that fiscal policy is still, can be a straitjacket for a country that has a very high debt to GDP ratio to begin with. The question is whether Europe will rise to future challenges. And I should remind you that the motto of the European Union, which is hardly known to anyone, certainly not to you, in Latin, in varietate concordia, which means in English, united in diversity. So I ask you to go forth, enjoy the rest of this course. In studying for the rest of this course and the rest of your life, and please value the fact that Europe is a European Union of many different countries with very different traditions and histories and languages and cultural traditions. Thank you very much.